Jin from Apis Partners, but he also has his own family office, has been doing a lot of research on the topic, trimming his content to be, full of couple of golden nuggets coming, so be aware. And then let's see if we have time for a few questions at the end. Let's do a big hand for Jin, yeah?
Sure. Thanks, everyone. So today I'm going to talk about future of capital allocation and how technology affects how you allocate capital. Just brief word about me. I've been investing in the alternative space, starting from the hedge fund industry, going to venture and growth capital for some of the largest institutions, including the Singaporean Sovereign Wealth Fund. I currently work for APIS, which is a growth private equity firm that does financial service and adjacencies. And it's a good performer. And more importantly, I also have my own family office and I allocate capital. From that perspective, I think it will be relevant for you. So this is the top, the holy grail is how do we generate sustainable risk-adjusted real return? And 1, 2, 3 are the hurdles you'll see. 1 essentially means the party's over and you're going to enter a period of sustained volatile low returns. 2, technology has fundamentally affected how you look at capital, supply and demand. And finally, you're going to see financialization of everything. So let's go into the past. We had benefited from about 45 years of structural tailwind from capital distortion, basically, as well as demographics. But it's all since reversed over the last few years. So let's look at it like this. On my left, you see about 125 years of US stock market history. The green area is from the 1970s, where the stock market took off in the US. And over that period, over 45 years, interest rate has declined from mid-15% to 0, driving all asset classes, not just the stock market, bond market, real estate market, private equity, all to this hunky-dory period of multiple expansion. That since 2 years ago is over, and we're entering a period, you see at the bottom, are some of the highlights here for implications for lower returns for all asset classes. What people underestimate is actually the inflation or the issues in the market. And on the left is basically the yellow line is the S&P for 100 years. And if you adjust that by the money printing that the US government does, it's flat for 100 years. You look at it from a gold price perspective, we're still below the dot-com boom. Basically, just to keep in line with money printing and inflation, you have to generate nominal return in excess of 10%. So the regime we're entering, you have to anticipate a structural higher inflation than the past. Geopolitics driving up high energy prices, supply chain coming back from China, driving up service prices, climate change driving up food and water prices. Everyone's levered up. So it's going to be a tough market, and you're going to see volatile lower returns because the interest rate will be structurally higher, not in the next 2 years, but over the next 10 to 15 years. So we come to the present, and there's a structural shift here we're seeing from how capital is going to move and towards the long tail, which means individuals, SMEs, emerging markets, smaller funds. And I'll dig deeper into what that means. Basically, we talk a lot about how technology or AI affects your work, but we never talk about, or some people do, about how it affects capital. Essentially, what is cost of capital? It comes as interest rate if it's a loan, premium if it's insurance, equity capital, cost of capital if it's equity investment. How is it priced? It's of information about your counterparty. And what does ABC, basically AI, blockchain, and cloud do? It gathers that information about your counterparty and intelligently synthesizes it and you price that capital. It's getting better and better, which means your risk premia narrows down very, very accurately over time. So that means flow of capital will eventually go to the long tail, which has been mispriced in the past. That's individuals, SMEs, emerging markets, smaller funds. So before this, I was with GIC, the Sovereign Wealth Fund for Singapore, and they were already allocating to alternatives. But now the industry has matured, and you have to think how you allocate. And there are three questions you have to ask. First, is this alternative asset driving technology, or is it receiving, i.e. Collateral damage? I would say parts of real estate or buyout will be in that camp. Secondly, I mentioned about structurally higher inflation in excess of 8 to 10% because of money printing in reality. And that means that it's tough for some of the debt-based instruments or infrastructure. Finally, the whole asset class has matured. And when that happens in any industry, there's more competition. Profit pool goes down, and so you have to specialize. And size doesn't matter at that point. So this is like 10 years of returns. And growth, obviously, and venture has done well. I believe to generate in excess of 10 to 15, I mentioned nominal, because of all the money printing, you have to compound growth at above cost of equity in the 15 to 20%. And there's very few asset classes that can do that. So we go into the future. I talk about how AI and blockchain and cloud affects structurally supply of capital, but it also affects demand for capital, and it financializes everything. So disruption happens when unit cost comes down, and it's combined with production and distribution cost. And technology basically is bringing both down quite fast, and it's going to drive explosive growth in financial solutions. So just like AWS created what you call software as a service boom, fintech as a service is disaggregating the production chain for financial solutions and driving non-financial companies to sell financial solutions on pretty much their installed base of zero distribution cost. And there will be a convergence to this. So this is what you call the financial stack. You see the internet currently today runs on just free information exchange, but the next stage of the internet is actually running on code that actually has a settlement layer natively to the internet. So basically what you had, the central bank rails or Visa or MasterCard rails, they are good for legacy purposes, but the use case will expand dramatically because you have new use cases. So people ask, why do you need these digital wallets, for example, when your bank account and your broker account is digitized and you can do anything? So there are companies that are currently streaming your salary by the second, or streaming your supply chain flow of capital by the second. The legacy rails cannot do that. Or you can start to program underlying assets, because now assets can be programmed because the unit cost to actually put logic to this using AI and some of the other technology is embedded, when it was not possible about even 15 years ago when all these bankers were doing this. So what you're seeing is a new layer of the internet where the current internet is basically dominated by Facebooks or Googles, where they monetize your private data. And that's why it's a consumer-based economy. And that's basically, the advertising is the main way to do it. In the future, when you layer in a settlement layer to the internet, you drive what you call financialization of everything, because any asset or services or content can be digitized and that can be monetized quite easily. So that is the next stage of the internet. And at the forefront, you're seeing amongst your children or the younger generation, they're spending more and more time in the virtual world because basically the financial service sector will be at the forefront from the infrastructure perspective, but from an application perspective, you should expect to see more gaming and media and some of the other assets that in the verticals that are more native to what I just mentioned, and then it will cascade down to other verticals. So let me just recap here. Capital has been distorted, and we had 45 years of tailwind. That tailwind is over. We're going into a period of extended, higher volatile, lower return period, where you're going to see difficulty in all asset classes, where multiple expansion, which drove in the past, will be rather multiple contraction, or neutral at best. Technology is structurally changing how capital flows, both from a supply and demand perspective, and there will be an explosion of financial solutions, which means based on this new Web3 paradigm, you're going to see financialization of everything, and financial service would be a meta sector. So for you to generate returns in excess of what I mentioned of 10+% nominally, you kind of have to find innovation assets and compound that quite early. And exits are not guaranteed because the IPO market, because we had sustained period in the past of sustained stable stock market, you had that window for IPOs. That will not exist. It's going to be very volatile, very macro-driven market, where so you're going to have to be quite nimble and time things also. So that's my presentation. I have 2 minutes for Q&A.
Questions? All right. Well, I think everyone's digesting lunch and digesting this information. But Jin Jung's email is here, and you can all follow up. Yes.
Well, thank you. Indeed, you gave a lot to think, and like having this conclusion.
Yes.
Just
Environment.
Depends on if you're a capital allocator or your GP, right? So you definitely have, in the chart I showed you on the S&P, the only sector that beat sustainably was the tech sector. So on average, if you did S&P, it was 8%. It barely beat inflation from a money printing perspective. So only the technology sector beat it. Now, if you're allocating within technology, you want to be early, but you want to handicap how early and what kind of adjustments you want to make, right? So you want to discover the future compounders as early as possible, but at a point where you're de-risked.
easier said than done.
Yeah, no.
Anyone else? Last takers. Yes, Carmen.
One more question.
So, yeah. So I was asked about AI and financialization.
Yes.
So AI comes in several aspects. So when I say financialization, the infrastructure to basically digitize and financialize any asset, service, or content is there. But because the infrastructure is now code, you can embed logic into these assets. So they will be smart assets. So let's say if I have a portfolio of 200 digitized real estate across the world, and they have rental income, if my income or cash flow falls below a certain point, you can start to embed smart logic into, yeah. So AI you can evolve into multi-agent, that kind of network, but you're seeing already very customized wealth advisor service, right? Using AI, because you just reduce unit cost to service this. Currently it's hybrid, but it starts with customer service like what Klarnet's done. But then you're going to expand into more on the front end, where you start to do it in using Gen AI for social media, obviously with supervision from people, but it will be more and more. It will involve less people over time.
A lot more to discuss over drinks, the culinary experience this evening. Round of applause for Jin Jong. Thanks, Jin.